Good morning, everyone, and very much welcome to our first panel of today. I'm sure, and I hope everybody is staying safe and sound. And I think, in days like this, we're looking at a situation whereby everyone just wants to stay robust and healthy, as well as, as far as we could, limit the contagion of this current mutation of the virus. But exactly, this is pretty much in line with what the Financial Stability Board recent assessment that was published about 1 week ago that has mentioned various points about how the crypto assets today has grown to a point whereby they could potentially pose a threat to the global financial stability. Now, we're not talking about another GFC, and nobody would like to see another GFC, but obviously, we're looking at crypto assets slowly growing to the tune of $1.7 trillion today in US dollar. When I last checked this morning, how Bitcoin has, sort of hover around the 36. It's still not substantial. You wouldn't say it's sizable. But what we're looking at now is Wall Street banks increasing participation, which is potentially a good thing. You see the Goldman Sachs, the Morgan Stanley, they're dabbling increasingly into funds and derivatives trading and backing Bitcoin. And you have also the buy-side firms, the Fidelity, launching the latest exchange traded products in Europe backed by Bitcoin. And very much quite soon, it could also happen to Asia in Hong Kong. We have the guidelines from the SFC, from PMA about a month ago, talking about how financial institutions would increasingly be able to, participate in virtual assets related activities. So we're very glad to have a full panel of very experienced and very much, very prestigious speakers along with us today to discuss this issue. Now, you looked at the topic today is CeFi and DeFi, and I'm sure you would probably have guessed the difference between the both terms. One is being a centralized finance, the other one's being a decentralized finance. But before I actually go into the panel, let me just introduce, all the four panelists here with us today. Or perhaps even I'll just, let yourself introduce, your background as well. Maybe I'll just start with Vince.
Oh, thanks very much, Angelina. I'm Vince Turcotte. I'm with Eventus Systems. And I've been working in the Asia-Pacific region for about 25 years. Through several of the recent, financial technology evolutions, and especially now interested in, obviously, the revolution in digital assets. I'm based here in Hong Kong, and I've worked all over the region. And I'm pleased to say I've had a chance to interact with most of the big institutions in the region who are engaged in this space. My job, more or less in sales, is to collect the views of the people in the market. And so I like to view that as me gathering information, not only from my firm, but to help recycle into the business and help it grow. Thanks for welcoming to the panel.
Georgina, hi, can you hear me?
Yes.
Hi, good morning, everybody. All our attendees today, thank you for coming out so early, and hi, fellow board presenters. Looking forward to this. My name is Angelina Kwan, and I'm the senior advisor to the board of the HashKey Group. And the HashKey Group is hopefully the next regulated virtual asset service provider in Hong Kong, and hopefully we'll get some good news in due course. And we'll talk a bit about that regulation in a little while in our panel. And basically my role has been to set up and make sure that the platforms operate, and that's what I've been doing in various positions with various digital asset exchanges. And I also have set up the compliance function at HKEX and other organizations. So I think this is the most exciting area, and I think there is so much to do. And with all the regulations, I think everybody on this panel and everybody that's actually taking part in this conference today will be assured of job security for a long time, and there'll be a lot to talk about. But basically, we hope the HashKey group will get its licenses and will be offering a regulated virtual asset service platform for Hong Kong in due course. So thank you again for today for Regulation Asia to invite us all.
Tung?
Yep. Hi, maybe I'll go next. Yeah, my name is Tung Lee, and I'm with Elliptic. We provide blockchain analytics solutions for crypto compliance. So most of my career has actually been with Singapore's public sector, with various stints in law enforcement agencies such as the police force and the casino regulator. Prior to joining Elliptic, I was actually at the enforcement department with the Monetary Authority of Singapore. So clearly, of course, I am based in Singapore. So building on my previous experience, I guess my foray into the crypto space, and especially my role in Elliptic, allows me to engage with potential clients as well as regulators to talk more about issues, understand their concerns, and see how financial crime compliance can indeed be brought to the crypto space. So thanks, Georgina, and thanks, of course, Crypto Regulation Asia for inviting me here.
Andy?
Thanks, Georgina. My name is Andy Meehan. I'm with Gemini Trust Company. Gemini, for those of you who are not familiar, is a cryptocurrency exchange based in the US and with offices in the UK, Ireland, and Singapore. I'm the Chief Compliance Officer for our Asia business. I'm in Singapore. Prior to joining Gemini, I spent most of my legal career in Hong Kong, where I was an advisor to several traditional financial institutions in the financial crimes compliance space.
Well, thank you very much, everybody. Thank you for your time. I know that some of you are not in this time zone, so a big thank you to you as well. Conveniently, I'm just gonna use the location that I'm based in right now. I'm in Hong Kong, so I'm just gonna start with the recent initiative published or joint circular, I would just describe it this way, by the HKMA and the SFC. Now they have this circular is opening up the opportunity and the prospect for financial intermediaries to actually conduct their virtual asset related activities. At the same time, they've highlighted how virtual assets are complex products. Financial institutions should ensure suitability, and they should only be allowed to professional investors. Now, we're looking at Singapore around similar time. Now, I was told that the MAS has also come up with a ban on advertising to the general retail public investors on digital payment tokens. That includes applicants of the Payment Services Act as well. So at this point, maybe I'll just perhaps start off and take your views, Andy. These guidelines, they're looking at what Singapore has, what Hong Kong has in place. Do you think that this is effective in achieving the goal of protecting the investors? And what would be the risk if I'm to say I have a blanket ban on retail investors altogether?
Thanks, Georgina. So let me start out by saying I don't think there's any question among the panelists here or any others in the industry that regulators have the best interest of the retail public in particular at their heart when they're coming out with these different regulations, different approaches as to how to regulate crypto. I think it's important to keep in mind when we're talking about this that at its core, crypto is a decentralized product that's been centralized in many ways because that centralization has allowed people to get into the industry through buying crypto with fiat and whatnot. But it doesn't require a centralized exchange or a centralized control in order to carry on that business. And so when jurisdictions impose requirements that limit crypto trading to institutional investors, for example, or otherwise, try to compartmentalize that segment of the population that has access to it. They're doing that because they have concerns as to the volatility or as to the suitability of the product to the retail public. But I think one of the problems is that because there isn't a single centralized point of access like you would see at a stock exchange or commodities exchange or something along those lines. It isn't really feasible for regulators, short of just shutting off access to the internet, to prevent their retail public from accessing crypto through exchanges that may be located offshore in unregulated jurisdictions. And almost anyone can find these just with a Google search. So I think it's important to balance the desire to educate and inform investors and retail investors as to the risks of the industry, while also recognizing that simply by not regulating not allowing for a license kind of regime in your jurisdiction, that doesn't really prevent your retail investors from accessing the product. And so the external cost of that is, by not having any kind of licensing regime that is designed to help protect retail investors, are you actually subjecting them to a higher degree of risk, because inevitably they'll go offshore to an unregulated exchange and conduct transactions that are outside of the scope of any sort of regulatory supervision and outside of the investor protections that most regulatory regimes have built in, whether that's safeguarding of funds or ensuring that an exchange has appropriate security provisions in place, or having a mechanism for dispute resolution or complaint issuances. So I think at the end of the day, it is, generally speaking, a more retail investor protection friendly course to try to establish a regime that gives retail investors the opportunity to participate in a market in a regulated manner. Now, of course, that's not going to stop a consumer from pursuing a offshore unregulated exchange and conducting their transactions with them, but at least it gives them the opportunity and the choice to deal with a regulated exchange where they may have better protections that ultimately serve the interest of the retail investors better than an unregulated offshore exchange might.
Understood. Very spot on. Angelina, I just wanted to also, you mentioned how at the beginning that the HashKey is actually in the process of applying for a license. I mean, when Hong Kong is actually going to have this new regime going to be able to have the legislature around summertime this year. From a startup perspective, can you share with us the challenges that you see in terms of fulfilling the AML CFT requirements, and how about the requirements on governance?
Sorry, how about the requirements of, couldn't hear?
Governance.
Yes, of course. So thanks, Georgina. Great question. It's interesting. We actually have two regimes in Hong Kong. The first regime was announced in November 6th of 2019, and that was called the position paper of the regulation of the virtual asset trading platforms. And at that time, a handful of virtual asset service providers applied, and HashKey was one of them. And what we did was we entered a sandbox with the SFC, and we've been working with the SFC ever since in terms of being a part of that sandbox. In 2021, there was one first house that was granted the license, approval in principle, and subsequently licensed under this regime. And that's the regime that we are actually under. So the license that we will eventually get is a type 1 and type 7 virtual asset service provider. After a consultation in 2021 under the money laundering reporting ordinance, a new regime will be coming in place, and it's currently being drafted by the law draftsman in Hong Kong. And that regime will also pick up the rest of the virtual asset service persons that are actually operating in Hong Kong, of which there are quite a few. And they will be required under the money laundering reporting obligations to get licensed, and we'll have to put in money laundering controls in place. Now, I'm proud to say that we use Elliptic, so just put in a plug for you. But under our license, under the sandbox, we have very stringent requirements in that we have to not only look at the entire effectiveness of our AML CFTC systems, but we constantly need to enhance, we need to put in place best practice, we need to constantly be updating. Very, very much like, if you know what the type 1 and type 7 is, it's very much like an exchange in a recognized market operator or a traditional exchange. So our requirements are very, very stringent. And the good thing is many of us come from traditional finance. So we've just had to learn how it will work in a crypto space. And there are many, many good systems in place now that are actually helping us out to do this. And then constantly looking at the whole ecosystem and what kinds of clients would be coming in, and constantly evaluating them. So it's not just, oh, we have to put this in. It's constantly evaluating and fixing and improving our AML and all our internal controls and following what the regulators have set out for it, what the SFC has set out for us. So it's really, really exciting, and it's been a challenge because you just have to think about, how is this different in the crypto space versus, oh, I've got a guy down the street that's come in to open an account and I just need to get their ID and photocopy it. Doesn't work that way in the crypto space. And that's why you've got picture taking with Elliptic, you've got face recognition and so on and so forth to make sure that they're real people even. So I think those are some of the things that that we are doing at HashKey to make sure that we comply with our rules and regulations. And I think the other candidates will also be putting this in place with the new licensing regime. I hope that answers your question.
Yeah, it does. It does. Thanks very much. And I mean, you worked for a regulator before, and now you're in the startup. And would you say that currently the requirements, it's a little bit more technologically challenging, or how do you see this?
I think for me, it's a real buzz because I've never been so excited before because we're learning so many new things. And there's so many new innovations, developments every single day in terms of technology advancing things that used to be really boring. And you're seeing how you can save time and be more productive with the new innovations that are actually coming in the market. And just the whole crypto space has changed from when I joined a very large exchange before till now. You're seeing different types of people, and certainly a lot of adoption by traditional finance as well as the crypto natives. I only just worry for the tech fin. We talk about this fintech and tech fin. Fintech are traditional people that have gone into tech, but you've got tech people that are going into now regulated businesses, and it's getting those people also now have to understand the psyche of the regulators, understand the rules and regulations, and really comply with them if they want to succeed in the markets going forward. So as I said before, there will be it's a very good time to be in this space, and it's the most exciting time, and I think it will only keep growing in this space.
Vince, you work with a lot of clients. I don't know if they've discussed with you about this new requirements in Hong Kong or perhaps in Singapore, but just to get your views. Now, in Hong Kong, the requirements from the MA and the SFC is that these institutions should work with only licensed platforms. Now, my curiosity is, do you think it's going to stifle innovations for bank and asset managers? And how do you see the future ecosystem evolving going forward?
Yeah, I think that there's sort of a quietly running inside joke about there being only one approved platform at this stage.
Hopefully two.
Well, no, very soon. And that I think that's the point. I think that they would not have issued that memo the Friday before Chinese New Year if they weren't actively engaged with a couple of other platforms to launch them into the space and grant their licenses. In fact, not only HashKey, but 2 or 3 other clients that I deal with have mentioned that they are sort of rekindling the talks with SFC after after a short dormant period. So there's a lot more interesting things going on there. I think you have to look at this development in the context of the continuum of things that Hong Kong has done and will be doing in terms of its regulatory structure. And Angelina did a great job of laying out that path, starting with the 2019 document and moving forward now into what we anticipate in July to be the launch on the floor of the new bill that will result from the Hong Kong Treasury Service Bureau consultation. And these things are really setting up what we believe to be a robust and solid ecosystem for trading digital assets in Hong Kong. So they're moving in a progressive fashion that I think is actually pretty smart. Very conservative in some ways. I think there are a number of people who are invested in the space who are a little confused and perhaps not realizing the business model at the pace that they would like to. But it's getting there, and they're being very clear. In fact, in the 2019 paper, they were quite clear about what they regulate and what they don't, and then what steps need to be taken in order to be regulated. And it mentions very specific and concrete steps. So it's also interesting in Singapore, and I really take Andy's point about the dangers of perhaps pushing people into an unregulated environment. But my read of what's going on down there is they're setting up for probably a bigger move into the new FSM regime that they've talked about launching, and there will be a more comprehensive single regulator with a new licensing regime that will focus more intently rather than the dual track that they have right now, which is of course outlined in the PSA as well as in the Securities and Futures Act. So you can in Singapore you sort of have to make choices in terms of which path you take, and it's caused, I think, some confusion and maybe some overinvestment. I only see that press notice that they gave about restricting advertising as sort of pumping the brakes. I don't see it as a halt at all. I think that it certainly is frustrating if you're a market participant there in many ways. But what I think that they're going to do is build a more robust system under the FSM that'll eventually be available to a broader spectrum of investors. Equally, Hong Kong, within that memo that came out before Chinese New Year, outlined specifically how retail investors could participate in the price risk of crypto assets, and that's mainly through futures contracts on recognized exchanges. Right now, that's the major exchanges such as the CME and the ICE. But they also said that ETFs were a possibility if there were futures-backed ETFs, similar to the ones that were launched in the United States after they were approved. And I see that as a step forward. You have to look at these things again as sort of a continuum, where they're going to be more inclusive in who they're allowing in and how they're giving risk to retail investors. But it's part of a larger plan. And as frustrating as it's been for us, as participants in the market, I think that patience right now with the regulators as they get together is really important. The last thing I'll say is that both regulators in Hong Kong and in Singapore seem to be gravitating more and more towards the FATF standards. They're really mentioning them within the context of the proposed regulations and the existing regulations. And so there is a global benchmark that people are leaning on. Moreover, I think that there's been an eye on some of the larger markets like the United States and how they're resolving some of these issues. Not specifically because they want to follow the United States or any other market, but because they want to make sure that there's a global lockstep. You can really see how the regulators do communicate with each other. I talked to several regulators, and they do, talk to each other about these, particularly the steps towards retail prohibitions. You remember that in the first week of January, there was, I guess, Russia, Spain, UK, Singapore, and one other central bank, I can't remember who, that all came out with these similar statements about marketing to retail and the tremendous risk of crypto assets to retail. That was a coordinated movement, I guess. And I think that you'll probably see, as larger regulatory jurisdictions take one step forward, you'll see the Asia Pacific not following them, but being able to stay in lockstep with those same standards. The last thing they want is regulatory arbitrage, where you're able to go out and say open an exchange in a far-flung jurisdiction and attract retail business into that. That's proven to be calamitous in a couple of instances. I think what they want to do is make sure that they present a cohesive, clear picture and a step-by-step path towards participation.
Yep.
I think
Totally
that, yeah, Angelina.
No, I was just going to say I totally agree with what Vince is saying, and I think all the regulators around the world are trying to work together. Some are working faster than others, but you're going to see basically the regulatory net is going to close faster and faster. So those, as I always say, it's either comply or die. And if you don't get regulated, it's going to be really, really hard to keep going in this space. And I think investor education, by the way, is going to be very, very paramount also. And it's exciting to see many of the exchanges now and different platforms also offering investor education in light of what Andy and Vince are saying. So investors are becoming also more savvy about this.
I think Gemini in particular does a pretty good job of that. And some of the work that they do, and it's a solid shop. There are a number of other firms doing the same thing, but they don't want to tarnish themselves with that kind of business that doesn't work for them.
Correct.
And it hurts everybody in the longer run. And I think you're seeing more industry participants follow that lead of doing the right thing.
Yep, which is good.
Does anyone think that we're going to have a Bitcoin tracking ETF soon in Asia, Hong Kong, or Singapore? Since Vince,
I would bet on it. I'd bet a paycheck on it.
I'm betting on it too.
Stay tuned.
I'm definitely betting on it. And I think it's important because then it'll be recognized that it's a coming of age in terms of this asset class. So we've already seen it in the United States, so it's time for Asia to start this. So.
Yeah, so we're evolving, after 10 years of Bitcoin or 11 years of Bitcoin, we're evolving with 12 from a centralized platform where ETFs could trade now to a decentralized platform. And I'm using my mobile phone to actually participate in a lot of interesting stable coin backed sort of deposit program, lending programs. It all sounds very interesting and attractive. Now, at the same time, from a regulatory and compliance perspective, maybe then we're looking at the potential of more challenges in finding that connection or the nexus of the DeFi players from the eyes of the compliance or from the eyes of the regulators. So now this panel is about regulatory risks and compliance, and and potentially whether it would be more challenging is my big question to Tung. Of course, you guys have published a pretty interesting report saying that there's been 12 billion losses, not like sounding like super high, but it's still substantial due to hacks and cybercrime on DeFi. So, I mean, is this making enforcement and compliance much more challenging?
Thanks, Georgina. Okay, so first off, let me just say that though we came up with the numbers, which may look, as Georgina pointed out, significant, one thing to remember is that in DeFi, assets do not go off-chain and usually remain traceable using blockchain analytics. So this is quite unlike centralized service providers, such as exchanges, where off-chain transactions can occur. In general, DeFi actually offers higher levels of traceability that can help law enforcement and regulated entities detect and deter financial crime. But that said, the regulatory landscape for DeFi, as compared to CeFi, has not been quite well defined. As you pointed out, this is due to the purportedly decentralized nature of DeFi and the lack of clarity on how existing regulations can potentially apply to DeFi, because existing regulations often rely on licensed intermediaries. However, we think that this situation looks set to change with the release of updated FedF guidance for virtual assets last October, I think, which Vince also alluded to. In the new guidance, FedF highlighted that persons who maintain control or sufficient influence in the DeFi arrangements, even if the arrangements seem decentralized, may fall under the FedF definition of a virtual asset provider or VASP. This makes, to me, a clear turning point in DeFi regulation, as regulators will increasingly scrutinize DeFi arrangements to identify those which should be considered as VESP due to the governance or ownership structure. And depending on the type of services provided, regulators will likely attempt to apply the same regulatory frameworks used in traditional finance to similar DeFi arrangements based on the principle of same risks, same rules. And indeed, again, as all the panelists have pointed out, there appears to be a coordination among regulators, because we have also begun to see more policymakers from organizations such as SEC, SEC, BIS express their support for such an approach. In essence, we are seeing increased momentum towards DeFi regulation based on the substance of the services provided rather than the form. And more importantly, regulators are also focusing their attention on identifying those DeFi marketplaces that claim to be completely decentralized when in fact they are not. Yeah. So I believe that in the short term, there will be more enforcement actions taken as non-compliance with existing regulations is uncovered. Just last month, Polymarket, a DeFi platform offering binary options, reached a 1.4 million settlement with the CFTC for doing so without registering as an exchange. The CFTC, interestingly, effectively singled out those in the DeFi space when it stated in a press release that all derivatives markets must operate within the bounds of the law, regardless of the technology used. So to me, the longer term implications are that DeFi operators will definitely be expected to implement regulatory controls to mitigate financial crime, including AML and CFT requirements. And in fact, and ironically, I guess, they are likely to be regulated in the same way as the traditional marketplaces that they sought to mimic and replace. I think one final point to note is that many DeFi platforms may actually welcome increased regulation. More banks are thinking about how to leverage DeFi, and more institutional investors are becoming interested too. For them to use DeFi, they will demand that such DeFi protocols be KYC and AML CFT compliant. And I think many DeFi developers are likely to oblige, since they clearly want to attract big money into the work they are doing.
Interesting. Now, you mentioned how these players would increasingly be regulated similar or akin to how traditional exchanges are being regulated today. So I'll just conveniently ask Andy, I mean, do you think that there would be any sort of risks or any sort of shortcomings if regulator would apply the same framework, existing regulatory framework, to the DeFi space?
Well, I guess I think Tung makes some excellent points in terms of how decentralized finance is in many ways not as decentralized as people may assume. Yeah. I would say, however, that I think it's going to be a real challenge for regulators to actually implement meaningful controls over the DeFi space because of the flexibility that DeFi operators have in moving jurisdictions and in changing, virtual identities. And so while the tools exist to bring enforcement actions against DeFi operators, I'm just, from a practical perspective, I'm not sure that enforcement is going to be meaningful in the context of the industry as a whole. What I do think is that there are opportunities for regulators to at least help inform the retail public as to the risks of DeFi and help to somewhat curate potential DeFi investments for the retail public by going through the regulated exchanges, many of which offer DeFi type coins, which are the avenue into some of these DeFi investments, and those exchanges that are acting responsibly have curated those tokens to some extent to make sure that they're not rug pulls, that they're not clear money laundering tools, that they're not other instruments for illicit activity. But are you going to really be able to meaningfully prevent investors who are savvy enough to explore their own opportunities within the DeFi space? I'm just not sure you can do that. What I think you can do is incorporate into the centralized finance regulatory regime ways to make sure that those VASPs, those exchanges, are operating responsibly when it comes to the DeFi type products that they're making available to their users.
Interesting. Now we're talking about DeFi, and the common currency used in this space a lot of time is stablecoin. Now, in the interest of time, I'm just going to bring this topic forward a little bit faster than originally planned, so that we can get to discuss a lot more different topics. In the U.S., in Hong Kong, we have regulators trying to propose a framework to regulate stablecoin, and specifically, they're looking at asset, legal tender back potentially to get them under the regulatory framework. Now, Angelina, I'm just wondering, what's your views on stablecoin regulations? I mean, is there anything that you think is stifling innovations, or is this necessary?
I think for any investment product to grow, I think there is some modicum of regulation that's necessary. And a very famous regulator once said, Angelina, if the market were completely au fait, we wouldn't have jobs as a regulator. So I think regulation, especially because stablecoins are becoming more and more important in terms of as a part of facilitating the crypto market or digital asset market in terms of entering from fiat to stablecoin, and then from stablecoin into different coins. So you're seeing different providers really come out now. And I think the HKMA has really hit the nail on the head. Our Hong Kong Monetary Authority, if you have a chance, please take a look at their consultation paper. They've actually taken a very balanced approach in terms of looking at, okay, we don't regulate them all. Is there a danger there? We regulate them to death. There's a danger there. So there's different varying levels. And I think the best approach that's being looked at right now that's mooted in the paper is a risk-based approach, which most regulators around the world use that. So I think this is a good method of thinking about the whole issue. They've actually gone out to consult other regulations around the world. The United States is actually talking with a number of stablecoin operators. And I think the world is a much better place now since Meta has decided to not launch their stable coin, which is much better. And I think that at least has been dropped. The Libra coin has been dropped. But now I think regulators are definitely looking at this and are taking an interesting approach. If they go the bank route, it's good in some ways, but it's also, it will be difficult for many of them because there's so much involved in being a bank. So they've got to strike a balance where they find a middle ground between good regulation and no regulation so that innovation can continue to occur in the stablecoin space and that yet investors are protected. So I think we'll be seeing a lot more discussion about this, and the consultation comments are due on the 31st. So we've got, in Hong Kong, we've got FinTech Association, the SIFMA, and a bunch of other organizations that are working on consulting. So please do put in your comments for that.
Yeah, definitely interesting paper. I read that, and I can definitely reread that just to, get a little bit more sort of take away from it. But the Financial Stability Board had also mentioned about the risks of stable coin to the financial stability. For example, I mean, if one of the stable coins were touch wood to fail, and then there's going to be risk that's going to spill over to the short-term funding markets, and then there's not going to be like a stable coin run, not a bank run anymore.
Yep.
Now, if I'm going to stretch it to the other extreme, you mentioned how Facebook Meta is not going to launch. The PBOC exactly is the one that has mentioned, they studied the e-yuan, e-renminbi exactly because they see the stable coin coming through, and it's better to have the legal backing digital renminbi for China, potentially Hong Kong. So now we do see China having some adoption of DeFi actually, And this actually stands in contrast to how the regulators have a blanket ban to everything under the sun for crypto in the centralized space. So with that, and Hong Kong is actually having its own regulatory framework for stablecoin. Vince, I'm just wondering, Hong Kong-China relationship, Hong Kong is doing its own regulatory framework. Do you see any potential at all, any scope for China to actually, re-enter the crypto asset space?
Yeah, sure. I mean, I think first I'd like to go back and touch on that point on stablecoins, and I think you've made it twice, and so did Angelina, that stablecoins are how the crypto ecosystem interacts with the rest of the global financial infrastructure, and whether it's using, for instance, the asset backed by just a currency or by a portfolio of assets. And the investment side of that also goes into a portfolio of assets. That's where the crossover is. And I think that's what the Financial Stability Board was really kind of worried about. Moving into your question on China, it's interesting to watch over the history of how China has interacted with digital assets, and even prior to that with several traditional asset spaces, and that they have always approached it cautiously. There was a huge blow up of random futures exchanges that were created out of thin air in the middle 90s that China dealt with very effectively, and at the time shut off all futures trading. But then eventually they've established a conduit whereby retail investors can take their X amount of foreign exchange offshore every year. I believe it's still $50,000. And they can invest that through brokers in Hong Kong in the global futures markets. And it's not hard to foresee an opportunity. And this goes back also to I think the point that Andy made, if you leave people no alternative, they will try and cheat in some cases. And the Chinese regulators are well aware of that. And they want to provide, I think, eventually a conduit for people to let off that risk steam, if you will. That's speculation at this point. But more underneath that, you have the discussion about the ECNY and the E-Hong Kong dollar and so on. Those are necessary preconditions to really having a stable digital asset infrastructure. In China, for instance, there's quite an active, I would say, NFT marketplace. And those NFTs are bought and paid for using ECNY, not using cryptocurrencies. Yep. So and they're on a closed blockchain. So they really don't interact with the rest of the world. So China has not turned its back on the technology at all. As a matter of fact, China is leading the world, I would argue, in NFT technology. What they've chosen to do, and it's actually very clever, is sort of by withdrawing some of the speculative interest in telling people to focus really hard on the practical applications of the technology. I think they're going to eventually lead the world. They're already looking at schemes to put everything like automobile registrations, university degrees, land titles, things like that, all into the NFT universe. That's really powerful. And it's an application that I think that I think the rest of the developed world can certainly learn from. So I don't have a doubt that eventually they'll re-enter the crypto space, but they'll do it in such a way where they can maintain the capital controls. I'm sorry, I'm burning up all the time here. I get going. Too much coffee this morning, but they'll maintain their capital controls and move back into the crypto ecosystem in a measured way at their own pace.
So maybe I'll just lastly just ask Tung if you can just give a very brief overview of Singapore or perhaps one more Southeast Asian country of what actually they're doing to address the risk posed by stablecoin.
Yeah, thanks, Georgina. So I think just to perhaps jump off some of Vince's points about stablecoins, becoming the convergence between potentially traditional services, finance, as in banking, as well as DeFi. So I think what is interesting is that such stablecoins with a value pegged usually to fiat currency could potentially act as money, especially they gain widespread adoption for payments. So that's actually potentially another nexus point for the convergence between these two vastly different spaces. So countries like Singapore, Hong Kong, and even Thailand have long recognized that such stable coins could challenge the way current legislation distinguishes between e-money and crypto assets for regulatory purposes. And I guess that's where China's example comes in as well, with its very successful adoption of similar digital money. So what all three countries are doing is actually consulting the public, as Angelina pointed out, on what risk-based stablecoin regulation could look like. But what's interesting is Thailand has taken an extra step last year of classifying baht-backed stablecoins as e-money. So this means that businesses that wish to provide services in such stablecoins have to consult with the Thai authorities to address any potential risk before beginning any operations. So I guess this is one way where, even with current legislation, stablecoins can be caught under certain regulatory ambit, depending on where the appetite of the regulators. Of course, other countries in the region, such as Indonesia, Vietnam, have taken a much less permissive approach by banning the use of all crypto assets, including stablecoins, as a means of payment for goods and services. So I think this difference in the regulatory approach really underscores the challenges that such asset-backed stablecoins pose to regulators. And I think this issue is gaining renewed agency because, as Georgina, you pointed out, asset-backed stablecoins are also becoming the common currency of the DeFi economy. And this means that due to their liquidity, they will often become either the target of criminals or used by them to launder illicit proceeds. So if issuers wish to avoid excessive regulatory intervention eventually, they really need to implement appropriate measures in KYC, transaction monitoring, to mitigate money laundering and terrorism financing risks. Because I think the industry will not want the regulators to come down hard. And as what some of you have pointed out, it may end up in a stablecoin regulation that's likely mirroring some of the policies banks are facing. And those are very high bars. You will create a lot of barriers to entry to small businesses. So I think this is something that industry really need to sit up and take notice and quickly move ahead of potential regulatory intervention.
Okay, thanks very much for your time. So in the interest of time, I'm just going to have to, sort of conclude this panel. And each of you, may I just invite you to just give me one sentence only of what do you think is the next big thing in the next 12 months in crypto? Maybe I'll start with Angelina. One sentence.
A move. This morning, NYSE bought a token company. You're going to see the move away from traditional stock to tokens eventually, or on the blockchain. I think that's my prediction this year. So let's see.
Yeah, I'm going to go. I'm going to go with that point and expand on it. I think the biggest thing happening right now is the re-entry of traditional finance firms, the Goldmans, JP Morgans of the world, ICE, as Angelina just mentioned, all coming back into the space in force to take a serious look at how to apply the technology.
Yeah.
Andy?
Yeah, I agree. I think mass scale institutional adoption in the space, and particularly with tokenization, is going to be a theme of 2022.
Yep. So for me, leveraging that, I think the key trend will be increased focus on consumer protection because of widespread adoption and likely more regulatory concerns over market misconduct issues.
Yep.
Sounds great. Thank you very much this morning for your time. And in the interest of time, I'm just going to introduce the next panel coming up. The next panel is on the travel rule, stopping illicit flows and frauds in crypto markets. And the panel moderator would be Manish, the editor of that page. Thank you very much for your time, and I hope to chat with you all soon on this interesting topic.